All right, let's dive into a question that pretty much every Canadian business owner has to ask themselves at some point. When you need a new vehicle or some big piece of equipment, what's the smarter move? Should you lease it or should you buy it? We're going to break it all down, looking at the money, the taxes, and what it all means for you. So, you found it, the perfect truck, the perfect machine that's going to help you take your business to the next level. But honestly, the biggest decision you're about to make isn't the model or the color, it's how you're going to pay for it. And that choice, leasing versus buying, it has these huge ripple effects on your cash flow, your balance sheet, and yeah, most importantly, your tax bill. And why is this so critical right now? Well, a big part of it is the cost of money itself. With forecasts showing the Bank of Canada's key interest rate hanging out around 2.25% through 2026, the cost of financing a big purchase is a major factor. Every single dollar counts, so you've really got to understand how those borrowing costs fit into the puzzle. Okay, let's start by walking down the first path. You decide to buy the asset. Maybe you're paying cash, maybe you're getting a loan. From a tax standpoint, this whole journey is about understanding a little something called the Capital Cost Allowance, or CCA for short. So here's the deal. When you buy a major asset, you can't just write off the entire price tag in year one. Wouldn't that be nice? Instead, the Canada Revenue Agency says, okay, you can deduct a piece of that cost each year over the asset's lifespan. And that yearly deduction, that's your Capital Cost Allowance. And this is where it gets interesting. The CRA groups everything into different categories, or CCA classes, and each one has its own special deduction rate. So that company truck you bought, it's probably in class 10, which means you get to write off 30% a year. But your new computer servers, they're in class 50, and you get a much faster 55% write-off. It all depends on what you buy. Now, how they calculate this is usually on what's called a declining balance. Each year, you take that CCA rate, say 30% for your truck, and you apply it to whatever value is left over. That leftover value is called the undepreciated capital cost, or UCC. So yeah, your deduction actually gets a little bit smaller every year as the asset's value on your books goes down. And if you took out a loan to buy that asset, you actually get two separate deductions. This is super important. First, you get to claim the CCA on the asset itself. And second, you also get to write off the interest you're paying on that loan. But remember, and this is key, the part of your payment that goes to the principal, to actually paying down the loan, that part is not deductible. Okay, let's totally switch gears now. We're going to move to the other side of this dilemma. What happens if you decide to lease instead? Well, from a tax perspective, it's a completely different world, and honestly, it's often a much simpler one. Right, so unlike buying with a loan where you have to separate out principal and interest and CCA, a normal business lease is basically treated like rent. The CRA just sees it as a regular operating expense. And what does that mean for you? It means your entire monthly lease payment can usually be deducted straight from your business income. Simple as that. It directly lowers your taxable income. Now, to get into the weeds just for a second, there are technically two main types of leases for accounting. You've got an operating lease, which is like a true rental. The asset never even shows up on your books. Then there's a finance lease, which is kind of structured more like you're buying it, so it does go on your balance sheet. But here's the main takeaway for our chat today. For tax purposes, the CRA usually just treats a standard business lease as a simple operating expense. You get to deduct the whole payment. So there you have it. Two very different ways to get the same asset. One path is all about ownership and depreciating that asset over time. The other is about, well, basically renting it and expensing your payments along the way. So let's put them head to head and see how they stack up. This chart really lays it all out, doesn't it? Let's break it down. For your yearly deduction, if you buy, you get to claim CCA plus your loan interest. If you lease, you claim the full lease payment. What about sales tax? If you buy, you claim one big input tax credit. That's the ITC, right at the start. With a lease, you claim smaller ITCs with every single payment. And finally, the balance sheet. Buying puts an asset and a liability on your books. A typical lease, it keeps your balance sheet looking cleaner. And look, the stakes here are pretty high. You don't want to get this wrong. As the tax experts at TU Inc. point out, messing this up isn't just about missing out on a few bucks. It can actually mean smaller deductions than you're entitled to, or worse, trigger a CRA audit. So you absolutely have to know the rules before you sign anything. So, what's the bottom line here? Where does this leave you and your business? How in the world do you actually make the right call? Well, it all comes down to asking the right questions. Before you pull the trigger, sit down, probably with your accountant, and think about this stuff. How long are you actually going to need this thing for? Is keeping your cash in the bank your absolute #1 priority right now? Do you want to avoid the headache of owning something that might be obsolete in a few years? The answers to these questions are going to point you in the right direction. At the end of the day, it doesn't matter if you lease or buy. The goal is the same. Get the tools you need to grow your business, but do it in the smartest financial way possible. Every single asset your business has is losing value over time. It's depreciating. So the real question you have to ask yourself is, are the financial choices you're making appreciating? Are they growing in value? Something to think about. Thanks for tuning in.